You're listening to Arsenal for Democracy, episode 399, recorded on Sunday, October 10th, 2021. I'm your host, Bill Humphrey. Joining me on the line, as always, from Idaho is Rachel. Hi, Rachel.
Hi, Bill.
So far on this mini-series, we've focused on answering fundamental and philosophical questions about the nature of money in the United States in the second half of the 19th century, and especially during the takeoff of the American mass consumer economy in the 1870s and 1880s, after the Civil War experiments with national paper currency. Last week, we focused on the death spiral of the sound money political battles between the gold and silver coinage factions, but the previous week, we looked at the early credit economy and the shadow lending economy of American cities in this period. This episode serves as an epilogue by showing how all of these trends and emerging forces resolved themselves into a more coherent system as the 1890s brought the century to a close and the 20th century arrived. Now that we've attempted to answer questions like, what is money, especially when there isn't enough circulating physically, we can examine how those monetary policy and emerging credit systems of the late 19th century turned into the iconic American consumption culture of the 20th century, and how that in turn became the 21st century iteration upon that. This week we'll try to answer how Americans, by the turn of the last century, started to become culturally comfortable with personal debt to make purchases, how this unlocked the full power of the 20th century American consumer economy, and how new modes of personal finance from the turn of the last century unleashed the all-consuming 21st century monster of monthly payment plans bundled by the millions as secondary and tertiary investment vehicles that are too big to be allowed to fail. This week, as in part 3 of this mini-series, we'll be drawing most heavily on the 1999 economic cultural history book Financing the American Dream, A Cultural History of Consumer Credit by Lendall Calder. But of course, when we cross past 1999, for the epilogue to our epilogue, we'll be drawing our own conclusions. The Calder content we will draw on today also heavily overlaps with The Rise and Fall of American Growth by Robert J. Gordon, published in 2016. So with that, let's get into the final episode of our mini-series. So the first thing we need to talk about is the ideology of credit. One of the big features of Calder's book is the author's research into the evolution of American cultural views on personal finances in the second half of the 19th century and the first couple decades of the 20th century. For the rise of consumer finance to occur, there needed to not only be a demand for it and a supply of it, but also an ideological propaganda campaign to break the hostility widespread in the American mind on the subject. Since the country's founding, the official line in American culture, setting aside practical realities, had been that you should live within your means and that there are two types of borrowing: productive borrowing, which is worthy and noble, and consumptive borrowing, which is profligate and evil. A productive loan would be a business loan, for example. You borrow money on your good name and reputation, your credit, and you make a business investment, such as opening a store or buying a piece of machinery for your company, that you hope will generate so much profit that you can repay your loan and then earn an income for yourself. A consumptive loan, on the other hand, would be borrowing money to cover personal expenses, such as food, clothing, shelter, gambling debts, and other vices. The line between necessity and disreputable prodigality was often blurred, so that borrowing money to replace an essential item of clothing was regarded as equally evil to borrowing money for a fancy dress or necklace as a frivolous and vain indulgence. Obviously, we've talked already about how desperation with shortages of money in circulation on the frontier and unstable compensation cycles in both frontier towns and American cities had pushed many businesses to extend consumer credit for basics like food and textiles, and many customers had been pushed to take out emergency loans or pawn property to make ends meet during the course of an ordinary week. And as we've discussed, there were already starting to be opportunities to purchase furniture and clothing on payment plans to help maintain or build the lifestyles of those on the economic and cultural edge between working class and middle class, as the latter began to gain a distinct identity. So to some extent, the pump was primed for a cultural shift because deep down many people knew it wasn't realistic to say you should live within your means. But there still needed to be a sustained ideological war to make borrowing and credit for consumer goods not only culturally acceptable, but essential and expected. As we talked about in the last couple episodes, had this shift not occurred, the American consumer economy after the American Civil War would likely have floundered and died with a vast overproduction of all manner of new goods with nobody to buy them and no money to buy them with. Calder's book charts the transformation of even the terminology itself from consumptive borrowing to consumer credit. Then, as today, lifestyle was that foot that was jammed into the crack in the door to force it open. As the Second Industrial Revolution got underway, a non-mercantile middle class was emerging as cheap industrial paper, the typewriter, and the telegraph suddenly came together to allow and enable corporations to form bigger and more complex consolidations around the country that required an army of white-collar clerks and administrators constantly doing paperwork all day. These men, and by extension their wives and children, were not rich industrial titans of the big bourgeoisie with their ownership of large capital formations, nor were they the shopkeepers and small business owners of the little or petty bourgeoisie, and they certainly were not performing hard labor for unreliable wages. They were simply modestly educated men on reliable salaries with surplus time in the day and a little bit, but not a lot, of surplus cash. The post-Civil War corporations churning out canned food from wartime food factories and mass-produced shoes and ready-to-wear clothes from wartime uniform factories, in conjunction with their newly created partners in the emerging field of consumer advertising, were all about creating new demand for their products, and that meant crafting a narrative around a lifestyle. The new middle class could furnish an apartment or a house and keep up with the latest fashions by buying or renting these things on installment plans. And if you were a successful laborer with a steadier job than most and looking for some cultural upward mobility, then you could do the same and enter the ranks of the new middle class too. People were already used to purchasing on a tick at the ledger of the local grocer or the general store, with accounts to be settled up later. The principle could be extended to payment plans. And most importantly of all, a consumer credit plan was, after all, really just a kind of productive borrowing, because what could be more of a productive investment than investing in yourself to keep up appearances? If you host the boss for dinner with your stylishly financed furniture and chinaware, you might get a promotion and move up in the world, and so on. The real coup, however, in the propaganda war to normalize and disguise consumer borrowing as being something distinct from the bad old consumptive borrowing, was convincing everyone that the truly fiscally responsible man was not the man free of personal lifestyle debt and scrupulously saving up for purchases later, but rather the man and wife who could religiously make all their payments on time through careful household budgeting and little cost cuttings here and there, and improve his lifestyle today. The dour old Protestants of the antebellum United States and colonial America had always warned sternly against borrowing for personal use, and held that it was the only morally righteous to save money and deny one's desires and vanities. The new Protestant man of the end of the 19th century understood that the truly moral fiscal rectitude and self-discipline was to shackle oneself to a world of monthly payment plans very precisely based on projected household incomes over time, and to scrimp and save to make every single payment on time, not to scrimp and save to put money aside for some unknowable future. Published surveys frequently sought to demonstrate that people budgeting to live slightly beyond their means through credit were actually more careful and self-disciplined with household finances than those who did not borrow or engage in credit-based consumption. Therefore, the paradigm was flipped on its head, where hedonistic consumption became viewed as the noble, difficult personal responsibility characteristic. Meanwhile, every company involved in this kind of buy now, pay later consumer financing was quickly discovering that offering these credit plans didn't just enable more consumption, but was actually quite lucrative in its own right. In the past, as we've discussed, when it had been done as a necessity in the cash-poor United States or to smooth out harvest revenue cycles in farm country, extending credit at a store was an expensive proposition in terms of delaying cash flows to pay back institutional investors and creditors, and thus it carried high markups on prices for the end consumers. But eventually, as consumer financing began to emerge in its own right, it became much more obvious to institutions that people's willingness to pay much more for a good over time could itself be turned into profit. No longer was the debate between cheap cash-only retail and marked-up purchases to be settled up later. Now, a vendor with access to longer-term loans at reasonable rates from a patient financier could charge a lot more for a good by spreading out the payments over time. All you needed was patience, and you would make much more profit per unit than if you had demanded lump sums or quicker payment in full. Putting up the investments to credit-based business activities went from a high-risk venture to a highly profitable business activity in its own right. This ideological transformation around people's understanding of credit and its place in lifestyles and moral righteousness, as well as the economic transformation around understanding how lending into the consumer sphere could itself be a legitimate and lucrative sector, laid the groundwork for the 20th century consumer economy, and also the 21st century economy of infinite loans and not production of goods and services themselves being the center of gravity in business. In the era we've been covering, this financialization was still a supporting sideshow to the main event, but as we'll return to later in the episode, the foundations of the current balance of power are clearly becoming visible, even at this early date. So Rachel, I wanted to get your thoughts on this ideological and cultural shift that Calder talks about.
Well, one interesting point that he brought up is kind of how dirty a word consumption was at the time. It was a euphemism referring to tuberculosis, as readers of period literature probably already know, and as Bill constantly references in casual conversation. And it was definitely a dirty word in regards to spending as well. There were editorial illustrations of wayfish and gaunt figures pawning their furniture for whiskey, and skeletal dandies wearing fine watch chains, really demonstrating the differences between terrible consumptive debt and moral and right productive debt. And kind of that shift in terminology really reflects that ideological shift and kind of the change in perspective around quote unquote good and moral forms of debt versus just this kind of base debt surrounding like trinket buying or a frivolous lifestyle. So one form of good debt was housing mortgages. Home ownership was kind of becoming an ideal. People were trying to move away from renting and own a piece of land themselves. So in the late 1800s, it was customary to save for a house and then pay for it to be built once the money was raised. Because the saving was a practice in patience and frugality, it was a moral endeavor, and it kind of showed how you were willing to sacrifice to get things later. However, by the 1870s and beyond, the price of a house, say $1,500, would take an average white-collar salary worker who was propagating at this time, really kind of becoming a bigger part of the economy. So the salary worker earning $1,000 per year, it would take that person 15 years of saving 10% of their income to afford that house. And most people didn't want to save that long and delay home buying for such a long time. So here comes financing. In the early days of housing financing, prospective homebuyers were still expected to contribute a significant down payment, about half the price. One example from Calder, and also cited by Gordon in his book, was the purchase of a lot and the cost of building a house, which equaled $3,000. The buyer would save $1,500, which would then be split into $500 for a payment on the land and $1,000 for materials and labor to build the house. The balance of $1,500 would be attained through two separate mortgages. One mortgage of $1,200 would be from a savings bank or from a private small investor. This would have an interest rate of 5 to 6% and would have priority over all other debts. When the house was almost complete, a second mortgage for $300 at 6 to 8% interest would be obtained from a real estate professional. These mortgages, again totaling $1,500, would be paid back in a manner that looks weird to modern borrowers. Buyers were required to pay interest payments semi-annually for the next 3 to 8 years, and then the principal would be paid off in a lump sum at the end of the loan term. This is what's known as a balloon payment mortgage. This lump sum repayment was also the same system farmers had used to purchase farm equipment rather than installment plans. There were a diversity of methods of home financing at this time. One strategy even included taking out 4 loans from 3 different sources to build one house, buying supplies and hardware on credit, taking out 2 loans from a loan office to pay for those supplies, and then securing a mortgage from a building and loan association. There were many sources for financing, from the aforementioned loan offices, savings banks, and building and loan associations, to even individual savers who happened to have money they were willing to lend at interest. So it was kind of a very different transitional time where money was coming in from many different sources and kind of used in a way that's very different from housing financing today. So kind of drilling down on these building and loan associations, they were an important source of funding for home buyers. They were cooperative societies designed to make homes affordable to families with modest means. They operated as banks without vaults, and oftentimes even without offices or salaried officials. Prospective homebuyers invested their savings as shares in an association with the goal of borrowing against those shares to finance a house at a low rate of interest. Borrowers were required to subscribe for an amount of stock equal to the loan they wished to borrow. Along with a membership fee and a premium paid for the loan, which was determined by auction, the borrower paid monthly interest on the loan at 6% and monthly installments on the shares. When the shares were paid up, the loan was effectively liquidated. Calder gives an example of how this worked. A borrower wanting a $1,400 loan would buy 10 shares in an association at $1 each. As a member of the association, he would be allowed to bid for the privilege of receiving a loan for $2,000, which could be obtained at a 30% premium. Making the bid, he received an actual loan of $1,400 to pay for the labor of building the house. The house and the borrower's shares were mortgaged to the association. Repayment of the loan occurred gradually as the borrower paid monthly dues on his 10 shares and interest on the loan to the association. In 8 to 9 years, the debt was declared paid and the mortgage released. As quoted in the book, the contract was crude and very few people understood it. However, this type of mortgage was instrumental to our current method of home financing. In this scheme, both interest and principal were paid off concurrently, unlike the balloon payment mortgage. This style of amortized loan structure didn't become popular until the 1920s. Amortization made loans much safer for both borrower and lender, but the complicated loan structure was slow to take off. Banks were risk-averse to these long-term loans versus 30 and 60-day notes that could be called in quickly. And, until 1916, national banks were prevented by law from making real estate mortgage loans.
So that covers the category of home financing within the world of personal finance, but we have to talk now about the auto loan revolution because you really can't understand any of this stuff without talking about that. So the British podcast Trash Future, which we on this show listen to and greatly admire and often reference, has a recurring joke that is also an accurate observation of the economy today, that major American automakers like GM are banks that happen to make cars, because the lending part of the company is so huge relative to the actual production side of the company. Now, that's a joke that we've referenced ourselves many times in the course of our own episodes on economic history. And while that show is talking about present-day structures of car companies and the joke is commenting on the totalizing financialization of every business in the 21st century global economy, and that's a point we'll be circling back to before the end of this episode, there is one slight misconception contained within that joke, and that's the idea that this balance in the relationship between making cars and selling cars via financial instruments is a new one. In fact, we were surprised to learn in the process of researching this episode, both from the Lendahl-Calder book and from a passing sentence in Robert J. Gordon's 2016 tome, The Rise and Fall of American Growth, that actually the real story of the American auto industry from the beginning isn't really about assembly lines or mass production, but rather about auto loans. General Motors itself was formed in 1908, and by 1919, 11 years later, had established the General Motors Acceptance Corporation, or GMAC, its in-house auto loans financing division. These loan arrangements, with convenient monthly payments over a short fixed term, initially provided by local banks in conjunction with franchise dealers before GM pioneered the in-house strategy, were absolutely critical to the success of the nascent auto industry, just as late 19th century farm machinery manufacturers had discovered, as covered in prior episodes. Without a financing option, the customer base for personal automobiles would have remained small and rich. The enormous profits to be gained through mass production required mass consumption, and paying cash up front was simply not an option for almost anyone in the United States in the 1910s. Mass production also only worked if demand for purchases was year-round, which didn't work without credit to bridge the lean months, especially in rural markets. Automakers like Ford that tried to reject a credit-based system of auto purchases found themselves so quickly outcompeted in the market that they eventually had to yield. All of these car companies, within a short period of time, were entirely dependent on the business of offering auto loans to American customers, and because these cars became so ubiquitous, the auto loans themselves opened the cultural door that final distance to make consumer finance and monthly payments a perfectly acceptable way of living life. Without auto loans taking off when they did, it's difficult to imagine electric home refrigerators and other appliances like washing machines, dryers, and dishwashers becoming so omnipresent. It's also hard to imagine the planned obsolescence cycles of new models every few years being widely feasible without these short terms of financing plans. And it's important to note that auto loans in the United States were indeed loans. They were similar to, but marked a distinct departure from the financing methods we've talked about previously, like Singer sewing machines paid for each week over a decade or two, or player pianos in middle-class homes, or indeed the balloon payment system of farm machinery. So Rachel, could you tell us a little bit more about the specifics of how auto loans were structured at the beginning of this industry?
Yeah. So at first, credit really didn't exist in the auto industry, but it quickly became apparent that it was just going to be a tiny segment of the economy without credit. So the dealers often had to buy their stock not on credit. Credit wasn't being offered to the dealers, so in turn they couldn't offer credit to their customers. And this just really put the squeeze on the dealers. So first, dealers had to make a deal with finance companies to kind of take the risk off of them and allow them to buy cars on credit, which they could then extend to their customers. So this financial company industry really sprung up around the auto industry. And that's why General Motors created their own finance company, because they saw the writing on the wall. They saw that they needed to take their piece of the financing pie, or else they'd be shut out completely. So how it worked is when a customer was ready to buy, the dealer sat down with the buyer to explain the transaction, fill out a credit application, and sign a contract detailing the terms of the deal. Initially, auto loans required a hefty down payment, about 1/3 of the price of the car, and the balance paid out monthly for 6 to 12 months. Now, this short repayment period was pretty important to the finance companies, as automobile repair bills after the first year ran so high that the finance companies were afraid that the borrowers would be reluctant or unable to pay their remaining balance. So after the paperwork to buy the car was completed, the dealer would call his sales finance company over the phone, a credit check would be completed, which took a few hours, and the deal would either go through or be denied. To make sure the dealer screened applicants with care rather than rubber stamping all sales, risk was distributed between the finance company and the dealer through various risk-sharing arrangements. However, competition was fierce, and there was a race towards liberalization of these contracts. 12-month payment schedules were lengthened to 2 years or longer, and dealers were enticed with offers that relieved them of all risk when selling a car on credit. Also, many manufacturers quietly awarded subsidies to the major finance companies for contracts on the manufacturer's cars. Although the banks tried to encourage conservative lending methods through the formation of the National Association of Finance Companies in 1924, they were largely ignored. This is very reminiscent of today's car financing, where credit flows freely, and you see on car commercials, no one's denied, bad credit, no problem. So there's this quick race towards just kind of freely given credit for car buying. The one exception was Henry Ford. He had this moral conservatism, and he really hated the idea of consumer credit for automobiles. And so he tried to implement an alternative method for purchasing cars, the Ford Weekly Purchase Plan. Under this plan, a prospective buyer selected a body style at his local Ford dealer, then began a savings plan with the dealer by making a nominal down payment, which could be as little as $5. The dealer then opened up a savings account with a local bank in the purchaser's name, where it collected interest. The buyer would make weekly payments that would go straight into the savings account. The buyer was allowed to skip deposits and could also withdraw money in case of emergencies, though this would delay the delivery of the car. When the purchase price of the car had been accumulated, the customer would receive the car. This was in stark contrast to the buy now, pay later offer that competing finance companies were hawking. So, not surprisingly, it was a profound failure. In the first 18 months, only 400,000 people enrolled in the program, and only 131,000 of them managed to receive their cars, which was the equivalent of monthly sales for Ford cars. So really a tiny, tiny percentage of people were successful in this scheme. According to one Ford dealer, we often had to refund deposits. After people would get $50 or $75, they would want a vacation or something, and they would withdraw it. Ford's beliefs in fiscal responsibility and thrift just did not resonate with car buyers. By 1919, independent financing not approved by Ford was involved in 2/3 of Ford sales. This failure, or slowness to adapt to consumer credit, was also mirrored in the resistance of the Macy's department store to establishing any kind of charge accounts and an unsuccessful attempt to implement a prepaid depository account system with the store, which merely relieved someone of the inconvenience of carrying cash or making sure they had enough cash on hand for a purchase, but did not actually advance them any money they did not already have on deposit at Macy's. Both Gordon and Calder discussed this pre-1920s effort to kind of provide a false credit or kind of a layaway program that just really couldn't compete with people offering easy credit at this time.
So we've talked now at this point about the cultural shift involved in creating consumer credit as an element of personal finance. We've talked about the shift in how people financed the purchases and construction of their homes, and we've talked about the auto loans revolution. Obviously, we've sprinkled throughout this various allusions to the present day, not just to the 20th century consumer economy that we've certainly all, we're familiar with and have done episodes on. But we need to talk now about what is essentially the epilogue to the epilogue, the situation today in the 21st century in 2021. So today, almost everything in the consumer economy is some kind of monthly payment plan or subscription service. But also, much of the business world itself has come to revolve around the money flows of these consumer payments and in turn the resulting payments to each other, settling up accounts payable with accounts receivable, that kind of thing. And there are various financial innovations, so-called, some more legitimate or more scammy depending on the specifics, to smooth out payment cycles over time, offering both consumers and businesses access now to future earnings for easy terms of a higher payment here or a discounted receivable there. Finance, as a sector, is conceptually merely a means of economic time travel, promising to go to the future where all of your money is waiting for you and bring it back to the present where you don't have money on hand but need it to do something, whether it is to buy a new shirt or a house or to build a new bridge or a factory. And these companies just make their money on facilitating that transaction and using their amassed wealth in the present to substitute for a time machine to your future. Finance and capitalism, particularly Western capitalism, have always been inseparable conceptually, so it can be a bit reductive to describe the 21st century economy thus far as being primarily dominated by financialization. But the thrust of this argument is that the role of finance itself, rather than production supported by finance, has swallowed up the global economy. And I would argue that we can faintly see the origins of this at the turn of the last century and on either side of it by 20 to 30 years. Today, we are in a similarly deflationary period in the sense that the cost of many goods continues to drop, and in another sense, the stagnation or real decline of wages combined with certain costs like housing, childcare, and education continuing to rocket up has acted in an analogous pressure to what we talked about with the money circulation shortages and wage cuts of the late 19th century. There's not enough money going around, especially at the bottom of the economy, to support the level of consumer demand that the top of the economy has come to expect. Rather than flooding the market with dollars at the bottom and wage increases, once again, finance is the solution, just as it was in the late 19th century when faced with a similar challenge. And companies don't view this as an unsustainable pit of unrepayable loans. Rather, they see the immense profits to be made through the act itself of making regular payments on a marked-up base price. The object itself is cheaper than ever to make, and consumers are willing to pay many times its value over a long period of time for the convenience of not having to pay a lump sum in cash. This means that the entity financing the purchase is creating even more surplus value out of thin air than even the normal profit model does. To be sure, there have been stumbles for the industry, like the mortgage market collapse of the last recession. But mostly, the institutional private sector lenders have reconceptualized money so completely that they're thinking in terms entirely unmoored from traditional views of lending or borrowing. To them, the balance sheet flows of regular predictable payments from other companies or from millions of consumers paying off their monthly cell phone purchase agreement or auto loan is something that looks great each quarter and can also be bundled and repackaged to sell in bulk to other companies looking for somewhere to park their money, thereby quickly recovering their own outlay with a modest discount off an imaginary marked up value. With cash reserves accumulated so heavily at the top of the economy, That principal sitting around has to be invested somewhere, and thus has no opportunity cost to not being available as cash on hand, and it might as well be loaned out in the form of some collateralized debt instrument that will come back over the long run, even the very long run, with handsome profits, at least in theory. Even if the thing itself being invested in is a failure, the mandatory regular payments in the meantime will have repaid the principal long ago in most cases. There's an interesting argument made in David Graeber's 2011 book, Debt, the First 5,000 Years, which is probably debatable historically, but is at least worth considering conceptually. He argued that there is a massive difference historically between Western European capitalism and Islamic capitalism in their incentives, and thus their results, because of the prohibition on interest-bearing loans in the latter. Now, as a side note, in the former, interest was also prohibited for a long time, but Europeans kept finding loopholes and workarounds, in no small part due to the vast shortages of physical cash in Western Europe, as we discussed in Part 1. But even back then, these loans tended to be for business ventures and not personal borrowing, except among the high nobility and royalty. But to get back to the point that Graeber argued, he believed that Islamic capitalism favored investing in ventures on a profit-sharing model instead of an interest-bearing loan-funded model, and that this made Islamic ventures more about building something for the future. By contrast, he believed that Western European capitalism, with its dependence on interest-bearing loans to launch ventures, became by necessity more extractive, more destructive, and more violent, as he argued that colonialism and the Industrial Revolution both demonstrate. Again, I can't speak to the historical accuracy of this comparison, but there's something there conceptually. A profit participant shares a significant amount of risk in a venture and only makes money if the venture is a success. If it is a failure, there is typically little recourse to get back the money. A lender, by contrast, faces some risk of default, but generally has immense legal powers to recover the money owed, or at least a substantial amount of it. They also have the right to demand repayment, depending on the terms of the agreement and maybe the era we're talking about, either all at once or in segments at fixed predetermined intervals. The borrower has every incentive to rip as much money out of anywhere he can find it as fast as possible. Every day, that payment deadline is getting closer and the interest is climbing higher. The lender will be repaid, come hell or high water, even if it means getting blood out of a stone. And I think there's no economic model better suited to facilitating and profiting from a neoliberalized era of stagnant wages and underemployment than one completely based on lending for profit on monthly repayment terms, because that is the model best suited to getting blood out of a stone even after you think there's no more blood left to wring out of it. It's never about paying off the loans, it's just about making the little payments regularly forever. That's where the real money is, and that's how they keep you chained to the grindstone by your own self-discipline and fear of legal consequences.
I think it's interesting that you brought up cell phones because I've noticed the payment scheme or plan for those has kind of changed. I remember in the beginning when I first got a cell phone, you kind of got a reduced rate on a cell phone just for signing a contract that states that you're going to be a loyal customer of theirs for a year or two. And then in return, you kind of get this highly subsidized, highly discounted cell phone. And now it seems the contract model is outdated. And so you're not really tied to a particular cell phone carrier unless you buy your phone on an installment plan, which oftentimes now they're charging full price or quite expensive. And so you are agreeing to stay with that company for as long as it takes to pay off your cell phone. And by that time, there's these enticements to get an upgrade or there's some new model out that you have to switch to. And then the process starts all over again. You get your phone on installment and then you're tied to that carrier for probably the payment plans are stretched out for about a year or 18 months or so. So it's kind of the principle hasn't really changed, but the face of it has. It's kind of interesting. You're still tied to that cell phone carrier, but just not through a contract. It's through the debt that you owe to that carrier. So that's kind of an interesting point. And also, I think there's been a return to tying debt to morality. Dave Ramsey in particular is a name that jumps in my mind, and he really epitomizes this odd mix of financial advisor and evangelical Christian, kind of that prosperity gospel that has sprung up in the past few decades. And his view is somewhat extreme in that he views even productive debt, quote unquote, as bad. He discourages people from taking out student loans, and if you want to go to college, you have to save up for it and pay it off in real time. But I would argue that strict adherence to his tenets can be disadvantageous in today's society because credit and credit history really have become necessities in today's world. And if you want to buy a house but you don't have any credit, it really looks bad. Like, nobody's buying a house cash on hand now. It's very, very difficult to do unless you're, say, moving from California to Idaho or Montana or Oregon. So it's really unrealistic to expect people to pay for everything in cash.
And in fact, it's very difficult to pay for a lot of things in cash. Like the cell phone example that you gave, in many companies, you can't buy the phone, even at full price, in cash. You have to pay on a payment plan. And the reason is because that company knows that they need to bundle together thousands or a million contracts of payment plans on this phone and turn them into essentially something pretty similar to the collateralized debt obligations that we saw with the home mortgage sector before the last recession, because then you can package that, you can get it rated as a good risk. Oh, everyone's going to make their monthly payments to, meet the terms of their phone agreement, and that's a cash flow that you can then sell to another company, so they can put it on their balance sheet and make a profit that way while parking their money somewhere in the short term, right? And that's proliferated all throughout the entire economy, ultimately kind of stemming from the auto loan model of doing things. Although, as we've certainly talked about, there were obvious precursors around like Singer sewing machines and stuff like that going back to the mid-19th century. But auto loans is really sort of the progenitor of all of it. And then you also have the, similar setup eventually with home mortgages, especially starting in, say, like the, 1920s and so forth, after some of the earlier sort of more Wild West models had kind of faded away. And this is, like you said, you can't do a lot of stuff without not only having a good credit record, but paying for various things on credit, because that's the entire way that the economy is structured now. They need it to be structured this way. And you can say on paper, oh, look at all this unsustainable debt ballooning out of control. And they'll say, well, it's not out of control because it's based on people's monthly, income projections. And if those income projections don't hold up, well, they'll find a way. They'll figure it out. And, sometimes you'll have a little whoopsie daisy, like the entire housing market collapsing at once and everyone defaulting simultaneously. But most of the time, you just keep making it harder and harder to default or go bankrupt, and you make it easier and easier to recover the money. And wage garnishing is something that actually emerged pretty quickly in the even the legitimate side of consumer financing that was mentioned in the books. Obviously, there had been sort of the wage assignment, gray market, black market transactions happening in late 19th century American cities. But you do see pretty quickly, even in the so-called legitimate consumer finance era of like the 1920s and into the 1930s, that companies had pretty extraordinary means to recover money from you each month to make sure that you made your payments if you didn't. But for the most part, it's self-policing. People generally make their payments on time. They will go get money from another source, a friend, a family member, a payday lender or something, if they have to make that monthly payment on time because they don't want to get in trouble for not having made it on time. Or you have a credit card system where, if they don't make it on time or they don't pay in full, well, you're going to get more money from them over the long run by charging them interest on the fact that it was late or incomplete. So it's always structured as a win-win-win for these companies.
Yeah, I think that's where the value, you mentioned Trash Future. I think Trash Future really helps to demystify the way companies use debt or bundle debt and make it look good, make it look like a great investment and this company that doesn't even produce anything, and they're just like pushing money around on the spreadsheet without actually creating anything. And I think it's a really helpful primer on how today's economy works. So I think I know we recommend it highly in just helping to clear things up, like how does Netflix work? How does Spotify work? How do all these companies that are generating all this seed capital, how are they working without actually producing anything useful for our society?
Yeah, and again, you can see, as I said, you can see the faint origins of that stuff happening today in the 1870s, 1880s, 1890s, and into the early 20th century. It's not the same. It's certainly not the same in scale, but you can see the origins of it very clearly as being part of the same phenomenon, just at an earlier stage of development, right? Once those companies figure out that people are willing to pay more if it's broken up into easy monthly payments, and depending on what it is that you're selling, you make a longer or shorter term of repayment, or you make it into a subscription service where it's just infinite monthly payments, essentially. Once they figured out that you could do that, all of a sudden it opens up a huge new ability to generate money out of the ether, essentially, right? Because the product is only going to cost a certain amount to make. That cost is going to keep going down, down, down as technology improves in the manufacturing process and things like that, right? And as long as that remains true, you just say, okay, well, I'll just extend the payment terms, create this monthly payment system where they're going to pay for it over 3 years at a much higher price than they would have paid in cash all at once up front. And now all of a sudden we've greatly multiplied our potential profit per unit on this one item. Once you make that switch flip in your conceptual understanding of it, it becomes a lot clearer how a lot of stuff is working today. Now, granted, as I said, some of it today is just outright various frauds on either consumers or other companies, but there is a lot of it too where they're just like being very excessively clever about it and figuring out how to get money out of the future into the present through these various financial schemes. It remains to be seen how long that game of musical chairs can hold up, but as we talked about in some of the previous parts to this series, in some cases, as long as you insist that the music does not stop, musical chairs can go on forever. And it's pretty simple.
Yeah, I think it's interesting that you pointed to a parallel between today's lower income people and the conditions post Civil War. There's not a lot of money circulating amongst the bottom, I would say even 50% of consumers. And so there's that shortage of money happening. And so we are kind of trapped in this credit scheme because there's just not enough money circulating at the bottom and there's just so much circulating at the top. So we wouldn't really think of ourselves as having a kinship with the average person post Civil War, but it's actually we're more alike than we may think. I thought that was pretty interesting that you drew that parallel.
Yeah, and I think also, we might have much more regulation and government oversight, however little it is by comparison to what it should be. We have much more of it today than we did in the 19th century, but there is something fundamentally similar to having, every company that registers itself as a financial tech institution or every company that issues its own credit card. Basically, that's the same as those 19th century eras of banks just issuing their own money. And people having to figure out, at the time, well, is this worth X, Y, and Z? And the equivalent to today is that some of it's going to, it's all going to be denominated in dollars and everyone's going to agree to accept it more or less, unless you get into the crypto stuff that we alluded to on some of the previous episodes in parallel. But the main difference is instead of having accepting dollars at a reduced face value because it's from some out-of-state bank that you've never heard of, in this case, it's some app that charges you a higher interest rate. That's essentially marking down the value of your dollar, but you don't think of it that way.
Right. Yeah. There's much to think about.
Much
sure.
to consider. Well, that does bring us to the end of our mini-series on American money in the late 19th century and its aftermath. We have more episodes planned for the future, drilling down into some of the specifics that we only touched briefly on in this series, especially early design implications of things like home mortgages. But this series in 5 parts and 4 long episodes took us most of the summer of 2021 to research and prepare in between all of our regular episodes. And Rachel, thank you so much for being on this week to round out our mini-series on 19th century American money and to talk about the rise of personal finance into the early 20th century.
Thanks. It was a real pleasure to do the research and learn so much more about money.
And now you don't have to think about money ever again.
Never again.
Until the next episode.
Yeah, exactly.